power system frequency, it's not as tight as it once was. So we probably need, fast frequency response markets. We probably need to be thinking that, N-1 as the set point for your frequency suite is probably not sufficient anymore. It's probably not N-2, but it's more than N-1 because we're starting to get some new modes of failure that we haven't seen before. But these are all problems that can be with tweaking of the rules rather than throwing them out. My expectation is that the market, will continue to deliver.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm John Feddersen, co-founder and chief executive of Aurora. And on the show today, I'll be speaking with a real renaissance man of the electricity industry. He's the CEO of a major transmission operator. He's a professor of economics. He's been the head of a major government energy department. He's also been a power trader, leading one of Australia's largest power trading teams. He also happens, and I think this is a very positive thing, to be an Australian. My guest on the show is Paul Simshauser, CEO of Powerlink. Welcome, Paul.
Thanks, John. Great to be here.
So just by way of clarifying Paul's background, he's an economist by training. He's, as I say, the CEO of Powerlink, which owns the transmission system in the largest state in Australia's national electricity market. They have a 1,700 kilometre network. He's also a professor at Griffith University in Australia and a member of Cambridge's well-known energy policy research group. Paul, you've written widely on a lot of electricity markets topics. The one I'd like to start with is privatisation and the broader reform process that's essentially happened over the last 3 decades. At a high level, what parts of that privatisation reform do you think worked globally, and what parts have failed or haven't quite fulfilled their promise?
Yeah, look, it's a good question. I guess when if you look at the starting blocks of the industry back in and I'll take it back to sort of the 1980s, you could see that sector performance across a number of countries had been deteriorating quite badly, particularly in the US, Great Britain, Australia and other equivalent economies. I guess the significance was that for most of the 20th century, the vertically integrated power industry was a source of productivity and scale economy and technology development. But by the 1980s, I guess the industry had got into almost a habit of overbuilding and probably over forecasting demand growth. And what that meant for captive consumers was that their power prices sort of stopped becoming a source of productivity and an advantage and more of a shackle, and that was what I guess prompted the inquiry around whether or not it really was necessary to be vertically integrated. And actually, the first piece of inquiry on that lines can actually be traced back to, in fact, it was 1973 by Weiss, an American economist, who sparked, I guess, a line of inquiry about breaking the industry up and moving as it did across various economies, as we dial the clock forward then to the late 1980s, early 1990s, the effect of breaking up, generation, transmission and distribution and retail supply, particularly breaking up the generators and creating competitive markets, meant that the cost of that oversupply was effectively transferred out of the consumer welfare bucket and onto either shareholders of generators or governments who were sort of in the process of privatising their government-owned plants if that was relevant in those various jurisdictions. I think so that was a really important step in terms of getting introducing productive efficiency back into markets. And of course, when you're starting a new market with oversupply, consumers were always going to do well. We did, of course, find in a couple of jurisdictions where undersupply or market power sort of reared its head and actually started to unwind some of those gains. And I'm thinking specifically early Great Britain. I know there's sort of some well-documented cases with the the original breakup or perhaps lack thereof, and similarly in California. But in other markets, like, and I point specifically, one of the better executed reform processes anywhere in the world was really Victoria in Australia. I mean, it was reformed to within an inch of its life because it had the benefit of some of those earlier lessons from Great Britain. And then I think, what privatisation did for those that took that extra step, because not every jurisdiction sort of privatised assets. You usually, the restructuring process was, most important. But what the privatisation process would typically do is then let the capital markets start to really drive whatever lingering inefficiencies existed in government-owned organisations. It enabled them to extract them out. And also, for those parts of, where you had an entire industry that was privatised, the capital markets would start to dictate industrial reorganisation. So, for example, in Great Britain and in Australia, we broke up generation. We had a transmission network that was, the independent player in the middle, and typically retail supply was still bolted together with the local distribution board, as it was in Great Britain, or distribution entity or utility in Australia. And as various British authors have observed at that time, that was really the best that could be done given the complex interfaces between those two segments. But an interesting trend in both Great Britain and Australia was that capital markets slowly unpeeled the retail supply from distribution networks, and that was because, quite honestly, the investor appetite or the way investors would price distribution network monopolies was different to the way they'd think about a retail business that was effectively, operating in a volatile commodity market, losing its monopoly franchises over time, and that started to look like a much better proposition for generators, and that vertical integration or reintegration between merchant generation and merchant retail enabled or provided an inherent shock absorber to both business segments, and I can tell you that there is sort of economies of scope in those two segments, generation and retail supply, that were really discounted in the initial restructure. So that was probably the piece that quite often
economies
was
of scope.
underestimated.
Interesting about economies of scope. I mean, they feel like pretty different businesses to me. Could you give an example or two of where you see those arising between retail and generation?
Yeah, no, it's a good question. And because you're quite right. I mean, ultimately, any decision, if vertical integration was a terrific idea, the Ford Motor Company would have been a really big owner of cattle properties to provide leather to its own sort of, car manufacturing process. So we know that it's not necessarily a very good idea as a generic statement. It really is a organisational form of last resort. But in some industries, the transaction costs of being disintegrated just to exceed those of integrating. So, and I can tell you that the most recent sort of analysis I did of sort of valuing a standalone generator, a standalone retailer, and then adding the sum of the parts and comparing that to a sort of a seamlessly vertically integrated. And when I say vertically integrated, John, I'm not talking about equally sized generation and retail. They can be, the generator can be bigger or the retailer can be bigger. It's just a matter of how they manage to deal with the most complex parts of their exposures. The economies of vertical integration are around about 15 to 17% of operating costs. Mm-hmm. And if you're sort of thinking about sort of, what you'd expect from economic returns, it's sort of more about, you probably see a lift of returns from the combined entity of about 25%.
And that's in an Australian context, presumably.
It is.
And a lot of those gains would be from the sort of upstream, downstream hedge or something like that. Is that the key?
Correct.
Driver?
That's exactly right. Because it is a big, particularly in an energy-only market design. Perhaps it'd be, if you're in a different market configuration, you may well find those to be lower. But look, as a general statement, there's quite a big body of literature on this that's sort of done quite heavy quantitative studies of this, and they're the sort of numbers that you sort of typically see. And I guess one of the other observations I can make is that if you trace a generator, a standalone generator that's a merchant business, so I'm talking one without a long-dated power purchase agreement, but one that operates in spot and forward markets, and trace it over time and look at its credit metrics, it's going to turn up as basically junk on a credit metric perspective. And you'll find the same thing with a standalone retailer. It just won't ever really be able to exhibit investment-grade credit metrics. But when you bolt the two businesses together, as long as they've got a reasonable level of scale, you can expect our business with that configuration to consistently display investment-grade credit metrics, within certain sort of gearing levels.
It's an interesting point. And I suppose the reason I mention Australia is it points to the circumstances in which vertical integration makes sense. And I think, the theory in Europe at least is the closer you get to the heart of Europe, the more liquid markets, the less there is value in vertical integration. And I think the other one where you see it possibly, and we might pick up on this later, falling down is where you do get a long-term contract. So, renewables developers globally are specializing in that, getting long-term government contracts or at least being able to hedge with someone who wants green power. I think you're seeing some of those synergies breaking down.
I think when the moment you introduce long-term contracts, it breaks down completely. There's no need for it because there is no commodity price exposure or nothing of significance.
Yeah. So you talked about efficiencies from privatization, and you really focused on overcapitalization. Is that to say you think people say the British experience? We had probably 30% excess capacity in the UK, and that's a similar story elsewhere. People like building things when it wasn't privately owned. Is that to downplay the value of efficiency of dispatch and sort of price signals in real time? Was the big cost saving sort of buying big expensive kit, buying the right amount of big expensive kit rather than optimizing the kit we had?
Look, it's an interesting point. I mean, when you look at most, like the CGB or a Queensland Electricity Commission, which is where I originally came out of, you'd expect that those organisations in the main would have, dispatched their plant as efficiently as they could with their internal merit order. I guess the debate I recall very distinctly at the time of those industries being broken up was, well, surely, a monopoly provider can play off one supplier over another. I'm not sure that actually proved to be right. As it turns out, markets were a far more brutal incentive on individual firms to seek lowest cost out of fuel supplies or whatever their key inputs were. There was a whether it was sort of the over capitalisation of the system and its sort of passing on costs through monopoly rights as a vertical monopoly, or whether it was a market's ability to flush out newer, better, lower cost deals. I think all round sort of the result that we experienced in Australia and most sort of reform processes was that the early results were highly successful. I'd hasten to put the caveat there with a little asterisk. The early results.
I hope to pick up the sort of future market design shortly. Just one other question on the capitalisation point. Do you think the benefits were largest? We've obviously gone for very different routes around networks and around generation. Networks, regulated monopoly, and we kind of, I suppose, globally, converged on a particular version of how you regulate a power network. Do you think we've seen bigger gains in the privatisation of generation or in the privatisation of networks in terms of the efficiency improvements?
Look, it is very much a case by jurisdiction basis. I think. Look, I can tell you in the Australian case, the early gains in the generation market were very sizable. And I think, the networks were largely benign, but then we had, sort of quite acute episodes of gold plating in certain jurisdictions in Queensland. And I think, unlike Great Britain, there were moments in time where regulatory resets in Australia proved to be excessively generous. You know, they were, I guess, regulatory frameworks were a bit awkward, a bit rigid. And the moment you threw in something like a global financial crisis, you know, the usual tools available to regulators, you know, that was when they were tested. I mean, it's easy to regulate a business in steady, stable waters.
Yeah.
It's when they're choppy that you start to really stress test how good a reform process is. And I think, you know, my recollection of and I remember seeing a number of analyses, one by Stephen Littlechild from Great Britain and Bruce Mountain from Australia, contrasting the results. And you know, I think some of our government-owned and regulated monopolies here fared very badly. Perhaps more so from policy decisions than the reform process in and of itself, though.
Yeah. Okay, interesting. Why haven't, if we've seen these big cost reductions, do you have a theory as to why we haven't seen more use of privatisation reform markets globally over the last 20 years? I mean, it just strikes me, you know, look at the US and, you know, some of the markets over there still feel like the 1990s, and that's the way they've done it. Why? And even in Australia, I suppose you've got, you know, state-owned generators and you know, various hybrids of how this works with, as you say, Victoria at one extreme in terms of liberalisation. Why haven't we converged more on the optimal model here globally, and why do we still have quite a lot of state involvement in the electricity sector?
Look, I would say there's two key streams of inquiry there. One is ownership and whether you know, sort of parts of the industry were, you know, owned by governments or collectives rather than privatised. The second issue too is whether markets were formed or whether they stuck with a vertical, you know, regulated monopoly configuration. And of course, there are a number of places, a number of states in the United States where, you know, it's may well be private but still vertical, and no decision was ever really pursued by the various jurisdictions to go down the reform path and create markets. And I think that's because, you know, there were flashpoints in our journey. I can tell you that I think, you know, the moment in time for, you know, as the Californian market was rolled out, because of what happened in that it was largely boilerplated on the Great Britain experience, with the caveat being that probably not enough was done on the supply side to create sufficient competition. You obviously had the whole series of things all going wrong all at once, leading to very high market prices, market power, all the rest in between, and that put a big stop on a number of plans for, you know, reform markets in that country. Similarly, I think with privatisation, it's not always politically popular. You know, in certain parts of, or I think in most of Australia, where you've seen privatisation occur, it was really, there was a burning platform. It was usually a jurisdictional government that really was had fiscally strained. So privatisation was a means by which to achieve a whole bunch of things at once. The governments that did not make it through that little window of opportunity, many of them have really struggled to revert or to pursue a privatisation agenda. And I think we're at least in the Australian context, what lies behind that was that our reform processes, not just in energy, but you know, and I'm thinking electricity, gas, telecoms, you know, airlines, labour markets. There was a whole range of microeconomic reforms that were, you know, sort of slowly wound through the Australian economy and the Australian experience, and it was tremendously successful. We managed to, by the time you got into the 1990s, when all those reform processes were starting to deliver their results. I mean, we haven't had an economic downturn in our country for 29 years. I mean, it actually took a global health crisis to induce one. So the last time Australia went through a recession was 1991. So there's, you know, most of our population's never seen one before, but what they do know is that the spoils of all that beautiful economic reform were distributed in a very, very uneven sort of manner. And I guess when you're in a rural or regional community in parts of Queensland or New South Wales or various sort of states around Australia, your recollection of organisations like the QEC being broken up and dismantled was that you would lose the local workshops, and employment was adversely impacted, and that's what they remember the most. So privatisation of these that final step in the reform process in those circumstances can be very difficult.
Interesting. Yeah, never waste a crisis. And it's interesting you talk about the example that happens in one part of the world being replicated elsewhere. I think you see positive examples of that in places, for example, the offshore wind auctions in the UK and GB are being replicated around the place. The British capacity market's being deployed across Europe. But interesting to hear how doing it badly can also lead to problems globally. Okay, so we've talked about historical reform. I'd like to, and you touched upon the future system. So are the power market approaches we have now, and by that I mean, the post-privatisation sort of reform types of structures, and those ones that really applied to centralised dispatchable generation, appropriate for the future energy system, in which I suppose demand is getting smarter and that's kind of technology enabled, generation's probably getting more decentralized and certainly less dispatchable. Do the markets we have right now broadly work, or are there flaws, and how might we fix them?
Look, I think interestingly enough, when I speak to some of my colleagues over in Europe and Great Britain, I get this distinct sense that they feel exhausted by markets, and there sort of needs to move off to some other way. And of course, you mentioned, government orchestrated auctions for CFDs and similar sort of what you might nominally call sort of, side market interventions and so on. I guess my sort of experience here and my sort of very hardened view is, I do think our markets can do the lifting that's required. You obviously need to put the various sort of targets in. If you do nothing, it's not necessarily obvious that externalities in the form of carbon emissions and so on will naturally get dissolved. So there needs to be some sort of policy guidance of those power markets. But I guess certainly the view I have formed, and certainly the house view of the last couple of organisations I've been working for is, don't throw out these markets, but they do need to evolve, given that you're now introducing near zero marginal cost intermittent resources and so on. The other thing that we're seeing a lot of in our long stringy grids is rising issues of system strength becoming quite an issue. Voltage oscillation, we're seeing frequency starting to look more like a car careering all over a highway. With the rise of intermittency and the loss of synchronous generation on the way, and so that we can't just sort of take the 1990 market model and expect that no change is going to work. But I think sort of throwing out the sort of the baby with the bathwater is not necessary either. And I think it's important. And just to sort of give you an idea as to why I think that's important. In our part of the world, we have managed to attract, the better part of $50-odd billion worth of investment in new plant in our market without, a huge amount of sort of intervention per se. There has been renewable energy targets, but they're just, all they're really doing is just pricing and externality.
Yeah, and they're very market based in Australia compared to
very
other
much
parts
so.
of the world. Yeah.
So I guess the thing about all of that investment is, we probably started out with a plant stock that was worth about 30 billion. So we've way more than doubled the size of the fleet, and certainly the value of the fleet. There's been over 200 utility scale projects spread across all the various technologies that have reached financial close, but over the last 20 years, absolutely now dominated by wind and solar projects. We had our initial wave of coal, and we moved into gas, and then into wind, and more recently solar, and we're starting to see batteries and sort of turn up, and there's obviously been some pretty well documented cases. So, you know, when I sit back and look at our market, I say, look, it's having to deal with, you know, a climate policy war amongst politicians, but it's nonetheless delivering on, you know, the reliability metrics in our market are, you know, generally very good over the last 20 years across the, you know, the four main regions. There's only really been one or two episodes where, you know, reliability sort of fallen below sort of, you know, the reliability standard. Power prices have, you know, they've had their ups and downs, but across the life of the market, they've been, you know, really very, you know, they've in the main been quite healthy. Yes, we've got all these intermittent, you know, generators coming in with zero marginal costs, but fundamentally the supply curve is still upward sloping. There's no reason why the market can't clear, provided we keep a close nexus between our, you know, value of lost load and our reliability criteria, as long as those two stay within tolerance. And then I guess the final thing is just to start thinking about things like, well, we need a broader array of ancillary service markets to deal with, you know, power system frequency is sort of, you know, it's not as tight as it once was. So we probably need, you know, fast frequency response markets. We probably need to be thinking that, you know, N-1 as the set point for your frequency suite is probably not sufficient anymore. It's probably not N-2, but it's more than N-1 because we've started to get some, you know, new modes of failure that we haven't seen before. But these are all problems that can be, you know, with tweaking of the rules rather than throwing them out. You know, my expectation is that the market, you know, will continue to deliver. And that's sort of in spite of, you know, the differences of opinion that exist between our two major political parties in Australia on climate change policy set points.
Yeah. So just to pick up at two of the areas you focused there was security of supply and I suppose grid stability and the ancillary markets. I'd like to just go a little bit deeper on those. Why wouldn't, and then maybe pick up on a third point around kind of locational signals and making sure we're using markets to build things in the right places. On the ancillary markets, there's a different version of this, which is these are small amounts of power. It's relatively low cost. The benefits of, you could procure a gigawatt for frequency response or 2 gigawatts for frequency response, and no one would notice it on their bills, but you'd solve a bunch of problems. Do you ever see the argument that these things are just too small and low cost to actually worry about markets? And arguably, I suppose the flip side of the same coin is that because they're small, competition will tend to be limited. You know, South Australian balancing is probably a good example of that. Is there an argument for just not bothering with markets for some of these smaller things and just saying, look, you know, system operator, procure a gigawatt of batteries and whatever else to respond to market circumstances?
Look, it's a really good question, and I've sort of oscillated on this, and I think you almost need to take it on a case by case basis. One of the key things about, you know, organised markets for, you know, to exhaust gains from exchange and imbalances, you know, they're enormously successful, but they're costly to run, and they don't work very well if you don't have competition. That's I guess axiomatic, and we have seen periods in South Australia where there's been shortages of that balancing, shortages of providers of frequency response. But what I can tell you is that, you know, when those shortages happen, it doesn't take long for the market to take hold, and you'll see a string of investment response occurring. And look, in my most immediate incarnation before my role here at Powerlink, I was indeed one of the renewable generators that had a footprint in South Australia. We had an exposure to the frequency markets because it's a causa pays mechanism. We were being stung by those rising prices, so we went and built a battery. And it was one of the first merchant batteries, you know, without any sort of real form of long-term contract from a government. We just went out on the strength of a very stiff and painful signal that was hitting our profit and loss statement, and we knew this would inoculate us from that. And look, we weren't the only one. We got in there quick, and so you could see that supply response very clearly, you know, sort of unfolding between. Look, I think it was between about sort of January 2018 and January 2020. There was something like 4 or 5 batteries rolled out across that southern market, more than 200 megawatts of battery capacity, probably with an average of around about sort of 2 hours of storage at a rough guess. So the markets will respond. But I think there are other markets, and I'm thinking particularly, system strength, and it's hard to define system strength, so I'll define it very broadly. But when you get a bunch of sort of, synchronous generators exiting the market, a bunch of asynchronous generators connecting, and you have all this sort of reverberating interactions between inverters, the logical solution at that point becomes, something like a synchronous condenser, tuning of inverters and so on. I think under those circumstances, I'm not sure that a market makes sense. I think you're better off just a little bit thinking of that system strength a little bit along the lines of national defence. It's a public good. We just need an administrative body to work out what the appropriate amount is, and then go do it. Install and then just try and spread the costs across the largest number of relevant beneficiaries as is possible. And with a close eye on trying, making sure that the response is proportionate to the benefits.
Yeah, and you sort of pull into contrast one of those other, I suppose, virtues of markets there, which is, would a central planner have decided, they'd need to decide on where to locate a battery for ancillary services, what size it to be, how to set up the grid connection. All of these actually, when you sort of look in a static setting, you say, okay, the answer is obviously a battery and a central planner could build that. But when things get more complicated and you actually have to pick a technology and do various other things, markets have a virtue there. And you just have to look, I suppose, at the types of technologies that are now providing balancing services, ancillary services in Europe, to say, well, no one could have forecast that, wind turning down was going to be useful at certain points in time, and flywheels were going to be useful at others, and it's actually a pretty complicated problem to solve.
Absolutely.
On the security of supply point, you said, in a sense, you sort of summarized it as we need to get involved of the value of lost load and the reliability standard appropriately calibrated. It always seems to me that it's a slightly provocative question here, but with energy only markets, you typically are relying on, lost load and government credibly committing to the lights going out and providing that price signal. Is that a sustainable? And in Europe, at least, I think there hasn't been a sustainable state of affairs, which is why we've seen capacity markets cropping up. No one believed government wouldn't act if the lights started going out. Do you think in general that's a sustainable state of affairs, or do you think that's an unfair criticism of energy-only markets in general?
Look, at one level, it is absolutely the case. That if lights go out and they go out due to a lack of supply, a lack of generation capacity, the government in that jurisdiction, the playbook. The first thing they do is set up the inquiry, and the inquiry goes and investigates, and they come out with their 10 or 15 recommendations, and unfortunately, in amongst them will be 5 really crazy ones, and all the crazy ones will get accepted. And I think everyone knows that in markets. I guess in our markets, what we've certainly in the Australian East Coast, and look, the same rules apply, of course, when you start to see those, supply side shortages inducing blackouts, it does become a problem. There is usually some sort of overreach from government. But what I can tell you is that in our markets, we have, first of all, with our value of lost load, it's a very high number, and it's amongst the highest in the world in Australia. It's the current price is, it's almost $15,000 a megawatt hour. And that's sort of just the risk of that drives up cap contract prices, on the basis of insurance. So if you look at what we'd call swaps, or the equivalent of a two-way CFD, so just a year ahead base load contract price, and compare that to the spot price, so an ex ante contract price, ex post spot price. The contract price is usually trades at about a 2% premium. The market's pretty smart. It's pretty hard to catch the market. That's on a base load basis, but when you start to look at a peak period contract price, it'll have a sort of an ex post premium of close to 15% on average. Now, obviously, in some years, you'll get a lot more than that. In some years, you'll get it wrong and you'll lose on it. But on average, over the cycle, peak period contract prices in Australia trade at quite a premium, and that's because of that risk of not necessarily the actual, but the expectation of a risk of some very high price events. And I can tell you that our one-way CFD, or the $300 cap contract, as we call it here in our country, it has typically traded at a 30 to 40% premium. And that shouldn't surprise you, because you're really talking about, as a retail business, for example, this is your insurance policy in case your house burns down. If your house burns down, you're obviously in a lot of trouble, so you can't afford to not have that insurance policy. And similarly, with an electricity retailer, you get sort of 10 hours of vol, and to the extent that would ever happen. If you're under hedge, that's likely to send your business into insolvency. So there's always this incentive to go and procure these instruments.
Is that a sign, though, of incomplete markets? I mean, and again, I'm not an insurance expert, but if we had sort of complete markets, I would have thought sort of you wouldn't see such a divergence between the expected peak price and the amount you need to pay to ensure the expected peak price, and an argument for some sort of government action to solve the incomplete markets problem. Do you see it that way?
No, I haven't. I guess I've always felt that it just represents a sensible premium for that level of risk. And when you look at the way our markets have operated, we don't see an undersupply necessarily of peak capacity. It is generally well calibrated with that value of lost load. And what you're really talking about here is the risk of a 1 in 10 hot summer. Obviously, in Australia, it's all about hot summers, not so much winter period. So all of the activity is driven by, what we call our quarter one cap contract. That's from January, February, March each year. And really what's happening is, what is the risk of a really hot summer coming through? And you're taking out insurance against that. And if 1 in 10 summers are exactly that, they have, and of course 1 in 10 years, those cap contracts end up being worth their weight in absolute gold.
Yeah, for sure. And I suppose if it is the weather that's driving it, there's no reason to think the reinsurance market couldn't. There's not a theoretical reason to think there's a market failure here. I suppose Australia is small and weather patterns are relatively uncorrelated. Across countries. And I guess the other point to note is that when you tally up the spot market and the contract market premiums, they start to get close to the total cost of the generation fleet, in an optimal form. So there's sort of no evidence of any inefficient or economic sort of or supernormal profits being extracted out of this. I mean, look, if you stare at the 1 quarter, yes, it looks like you're absolutely, sort of racing off like a bandit. But when you look across the business cycle, what you sort of observe is the spot prices alone don't quite cover the optimal sort of mix of generation plant. But when you layer in those contract premiums, you start to bridge a bit of that gap. Yeah. Okay, one more market question, then I'll move on. Location. So locational signals. You didn't talk about that in great deal when you talked about the future role of markets, but to me, at least, it seems like we've got a massive coordination problem around what renewables gets built where and how much of their power gets to market. Do you think the world, in this sort of markets-oriented view of the world, do you think we're moving towards full nodal pricing in high renewable systems in general as a solution?
Look, I have over in, at least in our part of the world anyway, you will never, I think, nodal price markets will always be more efficient than zonal markets. From a spot market perspective, and the question is whether or not, or the starting blocks of your market design. I think for any market that started out with nodal prices, they're probably in a very fortunate situation. For markets that are designed as zonal markets and which have relied on that sort of pooling of players to create liquidity in contract markets, it's a little bit like asking them, well, you're currently driving on the left-hand side of the road. we think we may need to now start driving on the right-hand side. So there's quite a big transaction cost moving from one to the other. And I'm not sure how we deal with the transition in between, other than, start having governments write, the sort of the CFDs. And I mean, if governments are happy doing that, I guess that's fine. I guess my query would be, in the current environment, that's going to be burning up balance sheet capacity that may not be the best use of their scarce sort of economic resources when they've got other things like health crises and economic crises to deal with. When a market can do that. But I can tell you that the zonal market here in Australia has had some very adverse outcomes, as we've sort of seen solar and wind, not so much wind, but certainly with solar projects. The barriers to entry are low. Firms have gone out and simultaneously developed projects. They've probably underestimated the level and extent of congestion, and as a result, in our country, we have marginal loss factors that are determined sort of ex ante for the year ahead based on the expected marginal loss. It's a fixed number for a range of reasons, but we've had some terrible gyrations for some investors. I hasten to add, though, that the investors that have been hurt the most by those location decisions are overwhelmingly pension fund investors. Mm-hmm. So if you tally up, more recently, when I had a look and saw, reviewed in Australia, there's been something like, $20 billion worth of renewable investments committed in the last 4 years, totaling around about, in the order of 12,000 megawatts of capacity. Most of that split, mostly between solar and wind, about sort of 5,500, 6,000 megawatts between each of those two technologies. But when you unpack who got really burnt by loss factors, it was actually only, by bad location decisions. About 2,500 megawatts of capacity, or about 25% of capacity ended up being poorly located. And the overwhelming afflicted party were sort of, pension funds or, superannuation funds. I can tell you the large, sophisticated incumbent utilities had a 3% exposure.
They could manage the risk.
Absolutely. Yeah. Well, they knew not to invest in silly places. They didn't need a nodal price to tell them where to invest because they'd look at the marginal loss factors and do the homework.
Yeah, and indeed, a recent guest we had on who's the CFO of a major renewables business globally, investing in Australia as well, says even in Europe where you don't have, you've got national prices rather than zonal, you still need to think about the underlying value of the power, irrespective of the market arrangements at any particular point in time. So, not surprised to hear that.
It is so important. I mean, I think, and there was a beautiful piece of work done by Leon Hirth.
I know Leon,
quite some time ago now. I think his first paper on this topic was back in 2013, but starting to make that connection between, don't worry about what the levelized cost of a solar or wind project is. Let's stand back and have a look. What's the value of its output? And that little piece of work he did sort of sparked an enormous interest. Certainly over here in Australia by me, but along with an awful lot of people in this part of the world actually starting to really zero in on the value, not only of the location of generation, but the timing of its output.
Yeah, great. Okay, excellent. Now, before we conclude, I'd just like to ask you a short, sharp section asking you about a few concepts in the energy transition and whether you think they're overrated or underrated. And it'd be great if you could just one-word answers. The discipline of one-word answers would be appreciated here. Obviously, if you feel you need to qualify, great, but in general, one-word answers would be great. So I'm going to throw a few concepts at you. The first is negative emissions technologies, like CCS, like air capture, like planting trees, I suppose. Do you think they're overrated or underrated in the energy transition?
Difficult.
Okay.
They will be difficult.
Okay. Second one is, I slightly overrated, that would be my interpretation of that. Demand side response and I suppose prosumers as a key source of flexibility in the power system going forward. Do you think they're overrated or underrated?
I think underrated.
Okay. This goes to what we were talking about before, centrally planned renewable zones. So zones where government says, right, we're going to build these transmission lines out to this particular area and we want you to build there. Do you think they're overrated or underrated?
Look, they're growing on me.
Okay. This is a chink in the market-oriented armor, I suppose. Could you elaborate on what is it that's made you have them grow on you?
Look, one of the things that is starting to become clear to me is that, particularly in a long, stringy system like the Australian grid, that when you lose a very large coal-fired generator, it's over 1,000 megawatts or over a gigawatt of coal generation, you really do need to replace that with an awful lot of renewables, and I can sort of start to see the value in trying to eke out the best resources available, and they aren't always where our existing transmission system is. The only fear I have over them is I'm always nervous about the Kevin Costner Field of Dreams strategy. If you build it, they will come. But I'm having to reassess, because I saw in New South Wales recently the government starting to talk, the idea of building a particular piece of infrastructure to pick up about 3,000 megawatts of renewable capacity. They had 27,000 megawatts of registered interest.
Yeah, so they are coming. So they're building it, and they are coming there.
It feels like if they do it, they will get their 3,000 megawatts.
Yeah. Next concept: gas as a bridge to a decarbonised power system. Overrated or underrated?
I'm going to say underrated.
Mm-hmm. Hydrogen as a source of zero emissions power, and that's power, not heat.
I've got my fingers crossed.
Okay. Yeah, it is an early stage to tell. Final one, and this relates to your current role: batteries owned and operated by networks. Overrated or underrated?
Underrated.
Okay, great, excellent. Well, thanks for being a good sport and keeping the responses to overrated or underrated. That's probably a good time to finish. I mean, we've covered an enormous amount of ground. It was absolute tour de force of the history of privatisation and where we're going. So, Paul Simshauser, CEO of Powerlink, thanks so much for joining me.
Absolute pleasure, John. Thanks for your time. Appreciate it.
That was John Feddersen, co-founder and chief executive of Aurora, speaking to Paul Simshauser, CEO of Powerlink. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.